Welcome to the series of Bay Area Battle of the Assets, where we pit the biggest investment titans against each other. In this episode 1, we start with the classic showdown, Bay Area real estate versus the venerable S&P 500. For decades, the mantra here has been, buy property, get rich. But is that still true when an index fund has quietly compounded double-digit returns? We're diving deep into the data to find out. Let's look at the straight historical returns. Over the last 10 years, the S&P 500 has generally delivered a powerful total annual return, often hovering around the 14% to 15% range, including reinvested dividends. Compare that to the appreciation in a Bay Area home. While local real estate has certainly soared, cash-on-cash returns on a non-leveraged property often trail the raw index. For instance, some broader national real estate analyses show an average annual return closer to 5.5% to 10.6% over various long-term periods, depending on if you include rental income and where you draw the lines. But here's the kicker. Real estate uses leverage. Leverage is the secret weapon of real estate. If you put down just 20% on a $1 million home and the home appreciates by 5%, your actual return on your cash invested is much higher. In some market analyses, particularly when comparing a leveraged real estate purchase to a cash stock investment, the leveraged return of a property in a high-growth area like San Diego, which is a decent proxy for the Bay Area, has more than quadrupled the S&P 500 appreciation over a 20-year span. This is the power of using the bank's money to magnify your gains. Of course, leverage is a double-edged sword. It magnifies losses too. But wait, there's more to real estate than just price appreciation. Let's talk tax advantages. Real estate offers 3 huge benefits that stocks generally don't. Mortgage interest deduction up to a cap, which is especially relevant in the Bay Area's high-price market. The ability to deduct property taxes, which is now capped but still valuable. And the incredible tool of depreciation. Depreciation allows investors to deduct the perceived loss of value of the building over 27.5 years, effectively creating a paper loss that reduces your taxable rental income, even if the property is actually increasing in value. You won't find that kind of write-off with your stock portfolio. So, while the S&P 500 offers higher liquidity and less management headache, Bay Area real estate, despite its lack of liquidity, can deliver superior leverage tax advantage returns. The winner? It depends entirely on whether you're willing to embrace the debt and the duties of being a landlord or homeowner. Tune in next time as we introduce the 2 wild cards into the mix, gold and Bitcoin. For more Bay Area real estate insights, scan the QR code to our YouTube channel. See you on the next one.